Welcome back to the channel, everybody. Today we're going to be talking about one of my favorite types of loans, and that will be the balloon loan. Many of you are going to be familiar with this loan because it was so heavily used before the 2008 market correction. Alright guys, so what are some of the pros to using this type of loan? Now in my opinion, one of the best uses for this loan are in the instances of a short-term investment or in an instance where you plan to fix the house up before refinancing it with a higher value after appraisal. Now what I mean by that is, let's say you buy a property at $200,000, but you use a balloon loan that may last, let's say, 2 years, and then when you move into it, you actually fix the property up so that when it reappraises 6 months from now, it's actually, let's say, worth $250,000 or $280,000 in the appraisal. So then when you do your refinance, you can actually pull some of your cash back out. At the same time, you have your 20% equity, so you do not have to pay the bank a PMI, which will reduce your monthly loan cost. Now, the second benefit is going to be, oftentimes these loans have a lower monthly payment because they're interest only. You're not actually paying the principal down while you have this loan. So instead of having 5% interest a year plus your principal pay down amortized over 30 years, you may have 6 years where you just pay 5% interest only on that set loan amount. Let's say $200,000, you're going to pay 5%. You'll be paying $10,000 every year until that lump sum of $200,000 payment to the principal is required. Now this is beneficial because it gives you more money on the month-to-month basis so that you can either work on that property or have money left over for other investments, as well as adjust your debt to income ratio. The third benefit to this is going to be it'll allow you to afford a home faster in the instance where you may have a lower credit score or a poor debt to income ratio. You're gonna take a riskier loan with the balloon payment, and it's riskier for you as well as for the bank. So you may not get the best interest rate up front, but because you're only paying that interest payment, you still might have a lower payment than with a standard mortgage. Now, this isn't necessarily a bad thing, because if you know you're building up in a career that you plan to have a significant income bump in a year or two, you know that in 1 to 2 years, you're going to have the credit as well as the improved finances or improved debt to income that you can actually refinance this loan at a better interest rate. And if you actually time it properly, in some instances, you'll get a lower interest rate than when you initiated the balloon loan if your interest rates have come down. However, that can also be a negative, and we'll talk about that when it comes to cons. The fourth pro to this loan is you're actually going to postpone your larger monthly payments because you're going to refinance this in the future before that lump sum comes, which will give you a little bit more money on a month-to-month basis, whether it be for a larger down payment in the future or just to have a little bit extra cash in the short term so that you can fix your debt to income so that you'll get a better loan in the future when you refinance. All right guys, so we talked about the pros. We got to talk about the cons with this loan, and this loan actually may not have a ton of cons, but the cons it does have are very important. Now the first risk to this loan is the fact at some point you're going to have a large sum due. Now, if you took out a loan for $200,000 and that's a balloon loan that you're only paying interest on, you're not actually reducing the principal balance of that loan. So if you take it out for 6 years and you only pay interest on a month-to-month basis, in 6 years when that lump sum is due, you still owe $200,000. Now this doesn't seem like a big deal because 6 years is a lot of time to refinance it, but you never know when a recession might strike or you might lose your job or have a major medical mishap that could leave your finances in disarray. And if your finances are in disarray, it's going to be much harder to refinance out of that loan, which leaves you at a significant risk the longer you carry it. So the second thing is, this loan is riskier to the lender, which leads to you having a higher interest rate, which means you're going to pay more interest to the bank for the use of this loan. And especially in the instance where you're doing interest only, you're going to have a higher payment of interest that money is not going to be realized from a principal gain standpoint. So you take a loan out for interest only at $200,000. Again, you're still going to owe $200,000 at the end of that loan, and all that money you paid to the bank up until now is gone. Now the third risk, and most important in my opinion, is the risk of markets changing. Now, I'm going to throw you guys a little scenario so that you can kind of follow along on why this loan could be so detrimental to your finances. Now let's say you take out a loan on a house worth $400,000 because you can afford that interest-only payment with the balloon loan, and you think, oh, well, my finances will be better off in 5 years, and I can refinance and get a better interest rate, as well as I may have saved some cash up to reduce the principal in a large lump sum payment when I take out my refinance or new loan for that property. So you buy your $400,000 property and you're only paying interest payments. And under your impression, that mortgage payment, once you refinance, is what the lender told you at that point. But what a lot of people don't realize is your interest rate for that refinance is not locked in. So when you get 5 years down the road and you go to refinance, well, if interest rates went through the roof, you could see anywhere from a 2 to 3% interest hike, which that's $3,000 a year for every $100,000 on a 3% interest hike. Doesn't seem like a lot, but on $400,000, it adds up really quickly. And it can make your monthly payment shoot through the roof. And if it's too high and your debt to income ratio has not improved, you may not actually qualify to refinance that loan out. Or you may not get the interest rate you thought. You'll get a much higher interest rate because the property is at such a high risk for you based on your current income. Now, that can work two ways. Interest rates could come down and you could actually end up with a lower payment, but that is usually not something you want to plan on. So these loans actually had a significant contribution to the 2008 real estate market correction, and I want everybody to understand why that occurred and why so many people went bankrupt using these loans as well as variable rate mortgages. So a lot of people went into a booming economy and they had great jobs, the economy was doing great, and their income just seemed to keep going up and up. And the interest rates were relatively low, so they were taking out these loans at $300,000-$400,000. And because they used these balloon payments, their monthly payments were relatively low. And people assumed interest rates would keep dropping. However, after 2-3 years, what ended up happening is interest rates started spiking rapidly. And with the spike in interest rates also came a lot of jobs going away. People started foreclosing on all their homes because they couldn't afford the adjusted payments when they had to refinance from these variable rate and balloon payments. They went from $1,000 to $2,000 mortgages to $2,000 to $4,000 mortgages overnight. And they basically were provided the options from banks to either pay off the sum of your loan or you needed to refinance it. And many people did not save the money they needed to pay off these balloon payments. And when the economy started to crumble, a lot of people lost their jobs, which ruined their debt to income ratios as well as their credit scores. And they couldn't refinance if they wanted to, or even if they could afford it previously, because they no longer had the financial situation to support this loan, and they were forced into bankruptcy. All right, guys, so I know it's a bit of a doom and gloom subject, but I hope everybody appreciated this video. There's a lot of pros to using these types of loans in the short term, but there are some pretty heavy cons and a lot of risk involved with taking these loans out. You can't always predict the future, and you really don't want to be caught in one of these loans if the economy takes a downturn. So it's really good to understand what you're getting into if you're going to be taking out one of these loans, and highly recommend that you have a plan B in place, whether it be private financing or a different type of loan, or if possible, save up the money to pay this loan off in full in the event that things go sour, so that you don't get caught into a bankruptcy situation. But if you like the video, guys, please like and subscribe. I'm working really hard to pump out a lot of these, and I'm trying to improve the channel as fast as possible so that you guys get the best possible content from me. Thanks.